It's my great pleasure to introduce the crude tanker panel today. We've got what I believe is one of the most interesting markets to discuss, and as soon as we all join here, we'll get the discussion rolling. I've had the pleasure of following the market for the last 35 years. During that time, I thought I began to develop some understanding of what's going on, and look forward to hearing from the panel today about how they have developed their understanding of the market and how they're adapting their strategies going forward to what is a very, very dynamic market. So let me start with introductions. Lars, why don't you lead it off? Who are you and why are you here?
Well, my name is Lars Barstad. I represent Frontline. We're a tanker owner listed both in Oslo and in New York. We have about 65 vessels on the water, evenly split between VLCCs, Suezmaxes, and LR2s, Aframaxes. I think that's about it. Lois?
Yeah, thank you. Lois Zabrocky. I'm the CEO of International Seaways, and we are listed on the New York Stock Exchange under INSW, and we have about 50 tankers. We're 2/3 crude, 1/3 product.
Hello, my name is Alafouzos. I represent Okeanis Tankers. I'm the Chief Operating Officer. Slightly smaller company than the two previous tanker owners. We have 15 ships, of which 8 are on order, 8 VLCCs, 4 Suezmaxes, and 3 LR2s. We're listed in the Merkur market in Norway.
First of all, thank everybody for staying. I wouldn't have, quite frankly, this late. I'm Burke, Ridgebury Tankers. We have 21 vessels, 2/3 crude and 1/3 clean. You got Paul.
Hi, I'm Paul Durham. I see my name is the last one on the program. I hope this wasn't graded according to age. I'm the CFO of Tsakos Energy Navigation Limited, based in Athens. We have 66 tankers, of which 34 are crude carriers, but actually 48 of them are currently trading in crude.
Thank you very much. If you all remember from last year's panel at this time, 2018 started with great promise. This was the year that we were finally over that terrible pace of deliveries of crude tankers to the market, where demand would finally take over as the driver, and we'd see the recovery beginning. That, I think, was the thesis, where the panel differed in detail, but that was the big picture. So far, unless I've missed something, I guess for the last 3 or 4 weeks, we've begun to see that now emerge. But the first half of this year has been a disaster. It's been some of the lowest earnings that this industry has seen in our databases since 1980, over the first half of the year. So you'd think that the industry would kind of pull in its horns, that the players would be conservative and just try to survive. Instead, the opposite has taken place. The VL in particular, but the crude tanker market in general, has been one of the most dynamic in terms of innovative decision-making on the part of the owners, and we have a chance to hear about the thinking going on here. If you all remember, at the beginning of the year, we had 35 VLCC scrapped, most ever. The fleet actually shrunk. I think, Kim, you were saying that we needed that purging. Well, we had it for a month or two in the VLs, but lest you think that there was a risk of a shortage of VLCCs, more than 35 have been ordered so far this year, and the year's not over yet. Some 30%, possibly some 30% of the VLCC fleet will be scrubberized by 2020. 30%. That's a number that we all ought to know. I don't know it well enough, but that has some very significant implications for the market. And owners have made critical decisions about how they're going to grow their fleet, how they're going to expand, whether or not they're going to consolidate or play a small, nimble player in the market. So we've had owners make sharp distinctions, not just wait for the market recovery, but make difficult decisions about how to prepare themselves for that recovery, how to play the winning game in this market. And over the course of the next 34 minutes, we're going to have a chance to hear from each of the owners here about how they plan to run their business, how they plan to succeed going forward. First of all, I'm going to start by asking everyone to talk very briefly about the supply and demand context and what they see going forward. Maybe, Lois, if you wouldn't mind starting off on this one. We see a demand recovery. Marsoft and our team back in Boston see the demand recovery, see U.S. exports, crude oil exports being a big part of that. What are the other, do you agree that we'll be seeing a recovery in demand, and where do you see it coming from?
You know, absolutely. I mean, I think that the U.S. Gulf, I mean, some of the projections are that we would double exports up to 4 million barrels a day, potentially by the end of 2020, and part of that could be the pulling out of the lighter crude and importing the heavier crude that the U.S. refineries can actually optimize. And some of that trade, I think, will really help the ton-mile demand, as refineries that don't have a lot of high technical capability pull on the sweet light crude, right? So it seems to me the U.S. Gulf, Brazil, some of these areas, I think that we'll see increases. It'd be great if Venezuela was able to recover. I don't think we should count on that.
Lars, what about you? What do you see?
Well, first of all, you know, with the new orders, we actually need these ships. You know, we're kind of approaching a period of time where all the new ships, you know, in the single hull, double hull kind of phase are coming to age and becoming 20 years. So you could say the order book is, say, 15% of the existing fleet, but 9% are going to be more than 20 years in the same period. And we have growth kind of in demand for tankers. So I don't see that as alarming kind of as it is right now.
Do you look for any particular source of demand growth? Is there anything that stands out in the market today as something that you're watching?
Well, kind of very short term, it's obviously the Iranian situation that might kind of be the catalyst that the market is looking for. You know, any kind of political change may kind of make the trading patterns turn. And we see it as quite possible that particularly Asia will source crude kind of from further away. Like Lois mentioned, obviously US as an export country plays a huge role. But in general, I think kind of now with scrapping and a more balanced market, the last year's theme was the inventory draws, just as with the clean sector. I think we're probably at a level where inventories are not going to draw much. We might even see building again. So I think kind of all those factors together points towards a more normal seasonal kind of upswing in the market.
Bob, do you think we're going to see a normal seasonal upturn in the market?
Well, first of all, I don't think we need any more ships. Does anyone else think we need ships? Ships are slow steaming, ships are laid up, ships are being scrapped before the natural expiration dates. Rates are below operating costs in some circumstances, certainly below break-even levels for most people who have bought ships that, you know, in a quote-unquote ordinary market. Banks are very concerned about restructurings or covenant breaches across the board. You know, I don't remember a time when we ever needed more ships, except during World War II, and I don't really remember that period. So I understand your point that it's not overly worrisome, but need might be a bit strong. So I was so excited there, I forgot your question, Arlie.
Bob, you got to stay focused. This is the demand side question. This is demand side.
Demand.
When is and how is demand going to recover in this for the crude tankers?
Yeah, I agree with the comments about demand. The demand has been there. Oil demand increases 1.456 million barrels a day almost every year, and every time they seem to be adjusting upwards a little bit. Of course, you know, we're focused on ton miles, and you know, I think the disruption in 2020 will increase demand. I mean, the problem we have as an industry, of course, is we see that and we order ships, we get excited and order more ships to anticipate that. You know, it's the tragedy of the commons. So I think the demand will be there. The question is, will too many ships be there to service the demand?
So we've got 2020 and all that brings. We've got the U.S. Gulf. We've got possibly more Asian demand shifting to Iran, I guess. Aristidis, what can you add to that picture?
Sorry, Bob and I are sharing.
Yeah, you're competing for a microphone there, sorry.
We're the two smallest group, please, so we have to share.
Although you didn't share the coffee.
No, I didn't. I gave it to Lois, sorry. Yeah.
No, I agree both with Lars and Lois that the end of the inventory period means that any incremental demand will be satisfied by seaborne imports, which is obviously all positive. As well as the new refineries that are opening up in Malaysia and China will help improve the demand, as well as the disruptions caused by the IMO 2020 changes.
Mm-hmm. Paul, any thoughts from your end of the table?
Not really. I mean, that's pretty well said it all. If I can just summarize then, we're looking at tremendous production. That's something that's been missing for the past year or so, and that extra production, not just the US, we're talking about Russia and generally OPEC as well, and even Brazil. We're looking at low inventories for a change. They've come down considerably, so they've got to come up again. There are new refineries, China and India especially. The 2020 build-up, which is going to be exceptionally good for crude carriers, and as we heard just a little earlier, for product carriers. And lastly, consumer demand is there. I mean, every year we're getting an extra, another billion little brats. So,
well, Paul, you'd be reassured.
the only thing that's disappointing is that they can't drive cars yet. So,
on the consumer demand front, you'll be reassured, Paul, to hear that I bought myself a new truck and got no scrubbers, just burns a lot of gasoline all the time. So I'm doing my bit to help the tanker market. Lars, let me challenge you a little bit on your fleet growth. Let me question you, about the fleet growth questions. Since when does a VLCC need to be scrapped to 17 years? I thought they were built for 25.
Yeah, no, they are in a way. The challenge is that our clients don't really want to freight them after 20 years. So it becomes a challenge. Last year I also spoke about the regulatory framework tightening, and us, the poor owners, have to, we have to maintain, we have to kind of certify, we have to have all the stamps and all the checks and everything in order to comply with the charterers' demands. And we're seeing a general trend that charterers, at least now when freight is too cheap, they kind of, they would rather have a ship that's less than 15 years.
Less than 15 years?
Yes. So whenever your ship kind of passes that age, it limits the amounts of clients you have, and it's not only the oil majors, it's the terminals, it's kind of, in order to properly trade your ship across the globe.
Yeah, Arlie, can I make one comment on that? I mean, the charterers certainly want newer ships. They don't need. I mean, these assets are built for excess of 20 years, 25 years. So, I would say that by having the oil majors and traders insist on younger ships, it's actually less ecologically responsible, because it takes a lot of energy to build a ship and make steel and to scrap it again and recycle it in something less than 20 years. And, they want new ships. They don't need them. I mean, the difference between need and want is subtle, but I can summarize it up. And my wife wants a mink coat. The mink, he needs it. And the charterers want new ships. They don't need them. But it's the market we face, and we were price takers, and we have to, we're slaves to what they demand.
Lois, let me continue on this point for a moment. The ships between, say, VLCCs older than 15 years old, mm-hmm. Can they compete with younger ships? I mean, are there differences in fuel consumption and other aspects of the operation that makes them less competitive?
Well, I'm going to look at that from two different perspectives, and I would certainly say that, if you take a 15-year-old ship and then if you take a, new building, your difference in daily consumption can easily be 20 to 25 tons a day. I mean, it can be that dramatic and significant. So I think if it was only the efficiency between the old and the new, or if it was only ballast water treatment installation, or if it was only that you would either need a scrubber or you have to then pay another $300 per ton, the 15 years plus would be less marginalized. But as an owner, and when you look at a vessel that's 17 and a half years old and you now are less efficient, you are going to have to put in ballast water. You know, you're looking at either putting in a scrubber or remaining now incrementally worse off. You know, it gets to be a very tough decision. But on the flip side, in a contango oil market, a VLCC can very easily store. You're not going to be consuming. You can sit there and make a lot of money. It's a very efficient ship. They are built for 25 years. I agree with Bob. It's our own fault. Like, we have spoiled the charters. So they can afford to have somewhat arbitrary standards.
Aristidis, one of the issues about the need for new building vessels, I guess, is the need for capital and the need for bank debt typically to support them. Have you found any limitations on investors or bankers in terms of looking at crude tanker new builds?
Yeah. Just to add to the previous question about the age of the ships. Luckily, we're in a position where, on a fully delivered basis, our fleet's very young. So, like, we'll have 1.7 years average age, and we don't have the question of the surveys of the scrubbers and ballast water treatment because they're already installed. But you have the element of the efficiency on the newer vessels. And then the other element is that over a certain age, you can maybe trade with certain charters once you're over 15 or 17 and a half. So, and that optionality is key to maximizing your commercial profit. And then the last element that over our experience is that for every year the vessel ages, we have an additional $200 to $250 per day extra operating cost. So if you have a 10-year-old ship, in our experience, we have an extra $2,500 a day worth of spare parts, paint. So there is an incremental daily operating cost as well. And in addition to that, once you're over 15, you have to dry dock your ship in the intermediary survey also. So that's like, instead of every 5 years having an off-hire period, it's every 2.5 years. And go to the finance question. Again, we're in a lucky position because the main shareholder has a long experience in the shipping market. So we do have access to the traditional banks in Europe and traditional bank finance. Which is still attractive, and they can lend at relatively high margins, relatively high LTVs with relatively low margins. Obviously, there's also alternative capital, which is more expensive, but if you have a solid name in the market, you can access that for higher LTVs or more complicated structures.
Do you believe that, therefore, newcomers with less solid names or who may be less familiar with to shipping bankers will have a harder time getting finance for new buildings than they were, say, 2 years ago?
Yeah, I mean, I think so, yes.
Lois?
You know, to me, it's sort of like one of the questions you had on the last panel is, you know, oh, how many MRs can Korea build? But nobody even talked about GSI in China. You know, oh, you know, ship owners can't find money. I mean, you know, to some degree, it's for our own good that there's less finance just readily available everywhere. And whenever you say, oh, there's not finance available, 5 ship owners will go and prove you wrong. So, you know, to me, it's a little bit of tightening up in the market can be a good thing for the long-term health of the market.
I agree completely.
Right. So, Paul, let me shift gears a little bit. I think at last year's panel you emphasized that you had charter cover and that was really the critical part of your thinking about all aspects of your strategy. That's turned out to be a pretty darn good bet when spot rates have been so low as they've been. Have you found any difficulty gaining access to capital to pursue projects that you'd like to in this market?
No, very, very, well, none, to be honest. We haven't had any problems at all, because that's what the banks want. They want to see their vessels chartered, the vessels that they're financing, chartered for a long term to a blue chip charterer. So that's been our aim, to build up and maintain and sustain our liquidity over this poor time. It hasn't prevented us from looking at opportunities, but those opportunities for us have always have to be vessels that we're building for charter to a blue chip client. and the banks queue up to provide the finance for those kind of deals. We've also looked at second-hand vessels, and preferably those that come in digestible fleets.
How big is a digestible fleet? Sorry to bother you, break in here. What's a digestible fleet? A big, small?
Biggish.
Biggish. Okay.
So we've looked at those kind of opportunities as well, taking into account, will a bank be prepared to help us in this kind of deal? And to our delight, they were happy to provide the finance for that kind of deal. From our point of view, however, we took a step back and said, okay, we have the ability to raise finance for the kind of deals we would like to do. But this kind of deal is a biggie, and we have no idea when this uncertainty is going to stop. How much longer are we going to see these kind of historically low rates? So we had to ask ourselves, what's our priority, the liquidity or fleet growth? And in the end, we had to, I wouldn't say we didn't get cold feet, but we certainly got tepid feet, and we backed down. And we decided we can afford to do it at the present moment, but it's too risky to go forward with this kind of new debt.
You had access to capital, but the weaker than expected market conditions in the first half of the year raised sufficient concerns for you to decide to defer investment.
Exactly. It weakened our desire to proceed.
Let me throw this open to the panel. We had VL rates $5,000 a day for the first 6 months of this year. Was that a problem? Did that prevent you from taking necessary investments that you regarded as attractive? Bob, we'll start out with you.
No, it was great.
It was great, you said.
Yeah, it's just great. When you already have a position, you get torn because you want to find a good deal. So you want the price to be lower, but also you're holding a book, so you're worried about that. And it comes to a balancing act. And the same thing with your investors or the investor world. They want a good entry point. That's another problem with shipping. Whenever you see a presentation, they always have good entry point. And it's always a good entry point. And the times it's going really well are few and far between, but that's what we all bet for. That's why we're here. So, certainly everyone has been squeezed except for folks who have all their vessels on time charter. And it's been an uncomfortable period for everybody across the board. And not just uncomfortable, but discouraging. I was talking to Marco outside. He says, every day you come in the office and it's just discouraging because it's the middle of the summer and rates are 5,000, 6,000. They went up 20%. They went up $1,000 a day. Let's go buy lunch. So it is discouraging, and you have to pull yourself up by your bootstraps and say, you know what, this is the time when you look back in 3 years and say, I should have done something then, which again is what Marco said, that's when I should have done something. Because we all know, we've all been here before, the market is going to change, and the rates are going to go up, and the asset values are going to go up. And what you have to do is position yourself so you buy the right assets at the right point in the market. It may mean new builds with charters. It may mean buying assets that will react very positively to 2020, and you can get your capital costs down low. And it probably means at this point in the market not over-leveraging too much, because first of all, the leverage isn't there. So at this point in the market, I think you need something that's not over-levered if you're going to go in.
So, Bob, it sounds like you had to forego opportunities that you might want under other situations have gone after. Is that?
No, we were constantly looking at opportunities, and we didn't pass on any deals that.
Lars, any comments from you?
Well, I just agree with Bob. You get into to work every day, and you just get depressed, kind of looking at the screens. And it has something to do with your conviction, right? So and if conviction is low, then obviously you're not going to be as aggressive, kind of pursuing acquisitions or things like that, and you get into like defense mode financially. So in order to manage your running business and basically keep the chips in the game for as long as you can. But I don't think it's for us. It hasn't really stopped us. It's just that we've, as everybody knows, we have pursued a few opportunities, but we haven't had maybe the conviction kind of during those negotiations, basically due to the market.
Lois, you've been pretty active. What have you managed to carry on that strategy while the market's been so crummy?
Now, it's interesting because, we have also sold older ships during this year,
Right.
on some of our vessels that you think a really hard decision to sell a 17-and-a-half-year-old VLCC, not for further trading. And on the flip side, we have been able to invest in the last 18 months that we've been independent, spent $600 million on 7 modern Vs and 2 brand new resale Suezmaxes, which are all very efficient ships. And now I'm ready for a good market. Yeah. But, it is, we feel like, to Paul's point, you don't want to get to a point where you're not comfortable with the leverage. You don't know exactly when the market is going to turn. You can do all your homework, and then, an overnight tweet can all of a sudden make your market, not materialize the way that you thought it would. So it's really important to have discipline and to make sure that, like our joint ventures provide us with some cash flows, and that helps during those rough times because you don't know exactly when that market's going to recover, although, of course, you have a view.
So there have been investments made over the course of the past year for new ships that are traditional play the cycle or play the market opportunity. There have been investments in other technologies that are distinct from the market cycle, scrubbers, obviously. The panel has taken different positions on that. Lois, I'll let you lead off with how you're thinking in that regard, and then maybe turn to Lars.
So I guess I would make it a really broad issue that I think ship owners are actually admirably dealing with, because we have to comply, and we will comply with the regulations. Come January 1st, 2020, we all have a big fleet. We have 50 vessels. So we put out an announcement today that we contracted for 7 scrubbers on our VLCCs option 3. And it really is something of a portfolio approach where you look at, you're talking about your exposure between heavy sulfur fuel oil and not even MGO. We don't really even have a 0.5 spec today. For ship owners, I think it's really it's coming at us. We will deal with it, and at the end of the day, ship owners will have to be able to pass a majority of this cost on through. It's really what the world decides we are willing to pay to have a greener planet, right? So that means, in a down market, it's very tough for owners, but ultimately that will flow through to the diesel that people burn in trucks, and, it comes all the way through. So I look at it as like it's a whole portfolio approach, and for us, it seems wise to be, I don't like to use the word hedged, but partially de-risked by installing some of the scrubbers.
Lars.
Yeah, no, we very much the same kind of approach. I think, first of all, the uncertainty kind of around IMO and the 2020 date was kind of taken away in March, April. Right. And that was when most of the owners started to act. Obviously, some has planned for a long period of time. Frontline has been looking at it for a period, but we chose to go kind of a little bit different way. And I have to put emphasis on that because, and I've discussed it with the investors today as well, putting these scrubbers on the ships is actually a technical challenging act. It's the scrubbers themselves are really simple. It's not really high tech, but there is even sister ships are different kind of with piping and all that stuff. So engineering is a huge part of installing a scrubber. We found that a direct collaboration between ourselves and a producer was kind of a good way to approach or kind of or attack the challenge. So, but agree with Lois. We're committed kind of for a few ships at this point, following the docking schedule, and we'll just see how kind of things develop from that.
What's the relevance of the docking schedule given the scale of the premiums in 2020?
Well, you could say that, but then again, we're actually up against an unknown price and an unknown product. So it's kind of 0.5% is not gas oil. It's a blend.
Right, no,
Yeah,
I
yeah.
absolutely appreciate
so
that.
it's kind of risks with the entire situation is kind of new to us owners. So we could go all the way and just scrub up every ship at any point of time, when they're near a yard. But we're not doing that investment now.
If you can't synchronize it, Arlie, then you're going to end up with 2 dry docks, right? So you're going to end up with double out of service time, and it becomes very expensive for an owner.
Well,
And the dry dock can accelerate, if you do a dry dock, it can accelerate or will accelerate your ballast water treatment system extension.
Okay.
There's that danger also.
that's a very good point. That's a very good point. Aristidis, you got, what can you share with us about your decisions on scrubbing?
Well, I mean, being a fresh entry into the public markets, our whole approach was this eco scrubber fitted fleet. So our fleet is entirely eco and scrubber fitted. So we're in a bit of a different position than the other owners on this panel. Our decision was purely financial or economical in installing these and trying to take advantage of the disruption that's coming with the IMO 2020.
Just, not everyone has the same degree of insider maybe as on this panel. You said you're both eco and you're scrubber. What does that mean, both eco and scrubber? Are they 2 different things?
Yeah. I mean, our oldest ship is delivered in 2015, so we have 3 2015 built Aframaxes. We have 4 Suezmaxes average age built in 2017, and another 8 VLCCs, which will be all delivered in 2019. All these ships have updated designs which make them more efficient, as well as derated engines, electronic engines. So there's a big difference between, let's say, a 2010 or 2005 ship in consumptions and a 2015 built ship. And on top of that, they also have the scrubbers, which allow them to burn HFO after January 1st of 2020.
Paul, you're talking to charters. Do they care about scrubbers, or to what extent does their caring about scrubbers reflect into the charter rates they're willing to pay you?
Well, we're in discussions now, so we haven't really come up with a finely defined term as to how we will treat the cost of scrubbers between us. Our attitude so far has been we will not put scrubbers in until we have more advanced technology as far as scrubbers are concerned. We do not feel that the kind of technology that exists at the moment is adequate. And what we're really scared about is that if we were to put scrubbers in our vessels, is there a risk that certain countries will decide we do not want you to deposit your sulfur into our waters, or a sludge which is contaminated, if you're going to use the closed system, which is highly unlikely. So that's really scared us, that there's a risk of paying $4 or $5 million to put a scrubber on one of our VLCCs, and to find out a few months down the road, sorry, you can't do that in our waters. And even if it's proved that the sulfur is not damaging to the environment, the concept that ship owners are dumping a certain chemical into the sea, even if the fish thrive on it, it just appears disgusting. And some politician somewhere down the line is going to make a name for himself by bringing in legislation that will ban those scrubbers.
But I mean, it would be interesting to see how long, let's say, a VLCC trades within like economic waters of a country, like when you're trading on a 90-day voyage, I think, how long do you actually trade within the economic zone of the United States that them outlawing discharge would apply for? Maybe 1 day, 1.5 days maximum.
Oh, in our case, we have a lot of days in the USA. Yeah.
The term sulfuric acid in the water makes great headlines. So I agree with Paul. I mean, the challenge we face is there are so many movable parts, and you've heard them all today and for months in the past about, the spread. The spread isn't perfect because there's not a 0.05, 0.5 right now, just a 0.1. Can you hedge it on paper? You can hedge it on paper, but there's a margin call. It could be tens of millions of dollars. The technology. How long will they allow us to put the stuff in the water? How long does a scrubber last? Are you going to put them on a new ship and then it looks like one of your 8-track players 5 years from now with a big hole in the dashboard? does it get obsolete, and you just have something you have to get rid of. And we don't have any real answers. That's what we all struggle with, and there is no right or wrong answer. Lois said the market has to pay for it, and I don't think that's true now. I mean, the market, it will be incorporated in the capital cost of ships going forward, but the current ship owners have to bear that burden today. And I think what we're all trying to do is, as Lois said, hedge, and that hedge could be on some of the ships, it could be, with your charterers, it could be on, on new builds, and just trying to get through this with the least damage. The philosophy that there's going to be a big spread, we're all going to be rich on the spread, that story gets diluted very quickly as more and more people put them on the big ships. If there was one guy on a VL who had a scrubber and no one else did, he'd get all the margin for himself. If every single VL owner puts a scrubber on, well, then obviously the charters will take that benefit away from us because we'll just beat each other's brains out again and come down to whatever the TC is in its current state based upon a scrubber-fitted ship. So ideally, we end up somewhere with 30% or 25% of the vessels having scrubbers.
Well, that's a really magic number, and I must say the scrubber discussion of the VL market has taken an odd turn in the last several weeks. Is my impression. It used to be an opportunity discussion. Do you want to take advantage of an opportunity on the spread and
Now
be
it
a
goes
first
defensive,
mover?
possibly.
Now it becomes, if you don't have a scrubber, are you going to trade at a discount? And there's at some point, and the reason why it's most important, of course, in the VL market, as you well know, is that this is the segment of the shipping industry that has been most aggressive in adopting scrubbers. What's your take on that? We'll go quickly. Lars, is it a defensive strategy now, or is still on offense?
I think it's, if you can say, it's a little bit of both, kind of. But first of all, it's natural that you put the scrubbers on the highest consuming ships. Because that's when your fuel saving is potentially the largest. I think, as also has been discussed around this, I think that an environmental benefit of putting a scrubber there is not really helping on emissions in a big way, to be quite honest. I think we need to look further down IMO's roadmap, to make some real change. By the way, I think that will have some kind of upbringing effect on fleet growth going forward, because if you're going to make a $90 million investment for something kind of that in 10 years needs to run on LNG, it's a completely different kind of investment decision to make. So hopefully that will help kind of the order books going forward. But back to your question, I think kind of once the legislation was cast in stone, I think we went on the offensive kind of, but there's so many complications here with also running on compliant fuel. So it's like a technical hedge actually to put the scrubber in. So it's it's kind of, I've spent a lot of time in the technical department of Frontline the last couple of months to learn.
All right, you've got 20 seconds each. The tweet you want to hear tomorrow morning. Bob, you're from my backyard. What's the tweet you want to hear tomorrow morning? Now you've got 15 seconds. Think fast, Bob.
Suez Canal closes.
Suez Canal closes. That's quite a tweet. Paul. We're governing by tweet now in the States, and this is something I'm just bringing here to share the joy.
Okay, the tweeter goes and visits Tehran with open arms.
The tweeter goes to visit with open arms. Very Lois.
How about that China and the U.S. have, no more tariff war?
Very good. Aristidis, what's the tweet you want to hear?
You had time to think about it.
Ours is definitely that IMO 2020 will happen January 1st.
Ooh. Okay, that's the last tweet you're going to hear, Aristidis. I got to tell you. Lars.
Oh, no, Lois took mine, actually.
You got 7 seconds.
Well, it could be U.S. infrastructure is all ready to export more crude.
Fantastic. Ladies and gentlemen, you've heard the tweets, you've heard the future of the crude market. Thank you all very much.